Hi, welcome to Retiring Well. Folks, you're going to want to stay tuned because we had a great show lined up for you today. I'm going to be talking about the fundamentals in the economy, most particularly what happened in the first quarter of 2021. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
Hi, welcome to the first quarter 2021 market update. Folks, I got a lot to share with you today, so I'm going to get started. So here's the major indexes for, you can see the last couple years, the first quarter of 2021, S&P 500 up 5.6%, Dow 7.5%, but look at the NASDAQ. The thing that was leading the charge all last year and last couple years for that matter is now kind of slowing down, only 1.7%. This is the S&P 500 over the last 1 year. What's interesting about this is last year the market dropped 34% in a 2-week period there in March, and now since that period, look what it's done. It's just been steadily up. You can see there's been a shift. Everything was going towards growth stocks, and now of recent there's a trend towards value stocks, which stands to reason. Technology was driving things through the pandemic, and now people are returning to those old stocks that are going to be there in the recovery. You can see corporate buybacks is back to pre-pandemic levels. Remember, the Fed, put a squash on a lot of that, when they gave the money out, but now they're freeing that up, and you're seeing buybacks back. This is just the S&P 500 versus the VEU, which is basically the world except us. Okay, we are much more globally connected than we realize, and you can see by looking at this chart, what the world does is pretty much what we do. You can see we've done just a little bit better this last year than the world, but pretty much following the same trend. GDP, we want to watch that. You look at 2020, you can see the first 2 quarters, obviously with the early pandemic, took a huge hit, is now, kind of came back, but for the year, basically zero growth, right? Just 0.3%. Now, first quarter, the first estimate came out for the first quarter is 4.7%. So we could see some stronger growth as we get towards a, recovery here. Unemployment, you can see was steadily going down for a number of years, and then with the pandemic, shot right up there, and now is consistently going down. Of recent, though, you can see that the tail is starting to slow down. It's not decreasing as rapidly as it was. This is inflation. You can see with the pandemic, it dropped down to 0. But now with increased demand and maybe a little bit of less supply, we're seeing inflation. Now, right now, it's getting close to 2%. That's typically historically where the Feds wanted to see it. But right now, they're signaling they'd like to see more. They're saying that we've had such low inflation for so long, they wouldn't mind seeing 3-4% as we go forward. You can see that this has now become investors' greatest concern. Last month, you can see in the light blue is pretty much the vaccine rollout. It's now switched to inflation. And now maybe possibly something happening in the bond market, with rising interest rates. So inflation is a concern. And why is inflation a concern? Because with inflation, people have less money to spend on goods, which affects corporate earnings, which affects the market overall. You can see it's not just investors, it's different age groups. What's interesting is the younger have more concern over inflation than even the older people do. So why would they? Because the younger are living more paycheck to paycheck, so inflation would hurt them more. March 19th, Jerome Powell came back out and said, while the U.S. economic outlook is brightening, the recovery is far from complete. Basically, they're telling us they're going to keep interest rates low for some time now. They're not going to raise that. They're not going to make that mistake when we're just getting back to recovery. And folks, they're just going to continue to pump money into this market to keep it propped up. You can see here with the Fed balance sheet, it was starting to taper off, pre-pandemic, and then with the pandemic, shot right up, and now has been steadily growing. They're going to keep the supply of money out there until we get there. Now, do I have some concerns about that down the road? Yes, because we're going to have to pay that back sometime. U.S. wages and salary growth, with the pandemic, dropped down. It was steadily increasing, and then of recent now it's started to drop. I take that with unemployment kind of, tapering off. That maybe stands to reason. There's a lot more people out there still looking for work, and so you're seeing wages, kind of taper off a little bit. Crude oil, having low gasoline prices is definitely good for the consumer, right? Because we have more money to spend, but not good for oil companies. They like to see the price of the barrel be at least $50 or more per barrel. It got up to, $60, $65 a barrel and maybe dropped down a little bit. So we'll continue to watch that. Gasoline demand, it's been, steadily on the rise. We're not back to pre-pandemic levels, but certainly people are moving. They're on the go. This is a CRB commodity index. It's basically just a basket of 19 commodities that we track. You can see with the pandemic it dropped considerably. Now back to pre-pandemic levels. So we'll see where that goes. This is just median sales prices of houses sold in the United States. For the last 10 years, you can see it's been, slowly on the rise. Of recent, just took a little bit of a downtick, but not a concern yet. This is just new single-family houses sold in the United States. It is kind of taking a drop, so not sure what that's about, but we're going to follow it and continue to watch it. This is just a housing supply, starting to take a little bit of an uptick. So I would imagine that the downtick in the houses sold, median houses sold, was because of supply. Now with the increased supply, we can probably expect that to be on the rise. All right, folks, we're going to take a break right here. I want you to stay tuned because I got a lot more to show you. Hi, listen folks, I want to invite you to a virtual live event. We're going to hold it April 20th at noon and 6 o'clock. We're going to talk about what is the state of affairs as we find ourselves today. 2020 with the pandemic, and now we're in 2021. There's a vaccine rollout. Where we stand today, where are we going? How should you position yourself to better be prepared for the situations we find ourselves in? So I'm going to encourage you, don't miss this event. Sign up. You can register online at cen-wealth.com. We'll see you there.
Christ Hope is a ministry that works in 7 countries in sub-Saharan Africa. We're focused on AIDS-affected orphan and vulnerable kids. And the first time I went to Africa, I remember holding a little boy named Joma. And Joma was 5 years old. He had AIDS. He had open sores in his mouth. He was skin and bones. He was lethargic. And they didn't know if he was going to make it. And I just remember understanding that Joma's mother was there also. She had AIDS. His dad had already died of AIDS. His sister had died. And this was a beautiful family that had been blown apart because of AIDS. And so Joma, thank God, has been able to get better because of drugs and ARVs. And even though we've come a long way in helping AIDS, it's still a huge issue. But children like Joma are vulnerable to being pushed off into orphanages and neglected and trafficked. And so we come in to help children like Joma be able to stay in families through the support that we do. We have about 1,700 children in our program right now. Interesting little thing, Christ Hope started out doing children's homes. But we quickly realized that the majority of children in the children's homes had families. And we moved in 2010 to a family-based preservation model. And we've seen a dynamic change and transformation in kids who are able to grow up in families versus institutional care.
Dave, I just want to thank you for Christ Hope. It's had a personal impact on my life. You attended our church, I think it was like 9-10 years ago, and you had all these little cards of these kids that we could sponsor. Out of that whole group of kids, I picked one child, and her name is Antonia Anthony Meadows. She was in the 4th grade. She just entered your program. We began writing with each other back and forth, and I understand now she's graduated. She's looking to go on to a university, and now our next step is trying to figure out how I can continue to support her in her endeavors, because I've grown to love this little girl, and so it's been probably the most rewarding thing I've ever done in my life, because, I think of that old analogy, that person, it was after the ocean kind of blew all these clams onto the beach, right? Yeah. and the guy's throwing the clams back, and somebody approaches him and says, you know, you're not making much of a difference. And he goes, well, I just made a difference to that one clam, right? That's how I feel with Antonia. I can't help every child in Africa, but I've been able to help one. And now since then, my wife has joined on and we're now supporting 2 new ones. So it's been very rewarding, and again, just want to thank you for all you do.
Thank you. And so our children now, the first children, Larry sponsors one of the children that was part of that. Antonia, she was able to live with her family, and she's graduating from high school in October. And she'll be exiting the program and going on to university. And she's a great testimony of the impact of this ministry, helping children to be not just healthy physically and academically and spiritually, but emotionally, is that they really grow because they have family. They're not orphans anymore. They have families, and they live in families. Yeah, and I just really want to thank Centennial Wealth. Thank you so much for believing in us and being a partner with us and supporting us in this. This is huge and has a great impact directly to the kids in our program. So thank you.
This is just a US dollar index. You know, since 1973, they compared our currency with all the world currencies, and they baselined it at 100, and then they've been basically tracking that ever since. You can see with this pandemic, it's dropped, 7-8%. Now, you know, having a dollar down is good for our exports because it makes them a little cheaper, but it's something we don't want to see continue for any long period of time. Right now, it's slowly back on the climb. U.S. consumer sentiment, you can see with the pandemic, took a big hit and then has been slowly on the rise of recent, a little bit more on the up. I think with the stimulus package that came out, I think people are feeling a little bit more confident. The Fed's keeping interest rates low, that, you know, and with the vaccine rollout, people are maybe feeling a little bit better. Consumer sentiment is got to be good because it's 70% of our GDP is consumer spending. So if people are feeling good, they're spending. And you can see right here, since pandemic took a big drop, people were tightening their belts. Now with, you know, as we get into recovery, they're starting to spend. But if you notice on this chart, it started, you know, it was on the up and now it's kind of curved. Don't know what that's about, but I imagine that's going to change with when a lot of people get the stimulus money that was out there. We'll probably see that back on the uptick. You know, I say this all the time, you know, we talk about the market, the fundamentals, and then sometimes the stock market, what it does, especially like last year, there's a huge disconnect, right? I mean, fundamentals are so poor, and yet the market was going up. We have to understand that the demographics of the people that are in the market are pretty much the top 10, 11%. As you can see right now, it's the top 10, 11% that own 88% of the stocks. All right, so, you know, they're not having to tighten their belt as much, and so they're still buying into a market. So very important to understand. Small business optimism. You know, they've been tracking this since 1986. Again, they baselined it at 100. There's a number of factors they're considering in this with employment and things like that. With the pandemic, took a huge hit, was on the rise, but of recent, you know, took a downtick. So I'm not quite sure what's going on with that. Businesses are feeling, you know, maybe the recovery is not coming back as fast for them, and maybe there's some concern there. U.S. manufacturing index, you know, when this is above 50, we're in expansion mode. When it's below 50, we're in contraction. Right now with manufacturing, we're clearly in expansion mode. Non-manufacturing index, this again, above 50 expansion, below 50 contraction. You can see we're still in expansion mode, but of recent took just a small hit. I liken that to like the small business sentiment, where we're probably seeing, because the recovery is, the vaccine rollout is happening a little slower than they wanted, and businesses are not fully back to full capacity, at least from the small business level. That's probably a concern. This is S&P 500 PE ratio. Basically, it's taking the price in the market divided by the earnings over the last year. Historically, you've seen that be right around 17 times earnings. With, pre-pandemic, it got up to about 2021. Because of lower interest rates, they felt that was supportable. But folks, look where it's at right now, 40. It's certainly hitting some peaks. Now remember, that's a PE ratio is looking at the last 1 year of earnings, which have been a little bit lower with the pandemic. This is an interesting chart. If you look at where we're at with the PE ratio, now this is the CAPE ratio. It's not looking back 1 year, it's actually looking back 10 years of earnings. And you can see where it's been this high, that dotted line, earnings the next 10 years were very, very poor. So, valuations are high right now for sure. There's some concern though that, if those earnings don't get up there even faster than we want, we might see some slower earnings going forward. But if you look right now over the PE ratios coming forward, if all these corporations hit their expectations, okay, and we get the growth we think we're going to get this next year, where we find ourselves in the market right now, the PE ratio looking forward, not backwards, is 21 to 1. So that's back basically before pre-pandemic. So is that indicative of valuations being too high? Not necessarily. Not if the earnings come along with it. This is just some other indexes. The one I most particularly wanted to follow is the Russell 2000, which is, small business companies, and what that PE ratio is. If you look at the forward estimate, it was like right around 49. Folks, it wasn't that long ago when I was doing these updates that was almost double that on the high side. So it's good to see that coming down. And again, you can see the forward PE on the S&P 500 right about 21, 22. U.S. corporate profits the last 10 years, you can see was steadily on the rise, took a kind of a hit with the pandemic, now back to pre-pandemic levels. This is this U.S. corporate profits forecast for the next 3 years, basically on an upward trend. So again, as long as we can continue to see this recovery roll out fine and earnings are going to follow. This is just a volatility index, what they call the VIX or the fear gauge. It's just basically an algorithm to tell us what they think the market's going to do in the next 30 days, to the good or bad. Historically, the VIX has been right around 20, and it's right about that right now. So volatility is basically where it's expected. These are the Treasury rates as of the first quarter. One we're going to continue to watch is the 10-year Treasury, because that tends to affect mortgages and things of that nature and loans, and that's been on the rise. You can expect that. When you have higher inflation expectations, then investors expect to get more on their long-term treasuries, right, to keep up with inflation. So there's kind of a market-driven thing that kind of affects interest rates as well, not only just the Feds. But now you can see here in this chart, the 10-year Treasury going down, now all of a sudden starting to rise. Now, I'm not going to get too concerned about this unless I see this get up to about 2.5%. Then I think it's going to start to become a negative. Obviously higher interest rates have an effect on mortgage rates, which then have an effect on real estate and things of that nature. This is interesting. You look at, treasuries, the long-term treasuries took probably the third largest hit in quite some time. Because when you have higher interest rates, that affects bond values, because they have to discount those treasuries or those bond funds because of a higher interest rate. Because again, if I can get a bond paying 3% today and tomorrow I can get 4%, who wants my bond paying 3%, right? So they're going to discount it accordingly. All right, this would be a great time to take a break, so stay tuned because I've got some more to show you. Hi, listen folks, I want to invite you to a virtual live event. We're going to hold it April 20th at noon and 6 o'clock. We're going to talk about what is the state of affairs as we find ourselves today. 2020 with the pandemic, and now we're in 2021. There's a vaccine rollout. Where we stand today, where are we going? How should you position yourself to better be prepared for the situations we find ourselves in? So I'm going to encourage you, don't miss this event. Sign up. You can register online at cen-wealth.com. We'll see you there.
Through the school programs in our local school district, kids receive physical therapy to work on their mobility skills, occupational therapy to work on their fine motor and handwriting skills, as well as speech therapy to work on their communication skills. And during the summer months, there's limited school therapy available, and the children are selected based on their severity of need. So there are a lot of children with maybe some more mild diagnoses that don't qualify for school therapy in the summer. Due to the limited therapist availability and insurance restrictions, and also the high out-of-pocket costs, Kids on the Go provides programming for the children that don't qualify for school therapy and also might not be able to afford or gain availability to outpatient therapy. So it helps provide services similar to what they'd receive in school, only it's in a group summer camp setting. Kids on the Go is the first of its kind in the entire Northern Michigan region, and we're excited to expand our healthcare resources. Kids on the Go is 100% donation-based, and 100% of the funding received for our Traverse City program goes towards supporting local children. And our program is run by local physical therapists, speech therapists, and occupational therapists in our region, and it's based in a local school right here in Traverse City. Kids on the Go is rewarding in that it helps us watch children progress and develop their skills over the summer. And to me personally, it's so inspiring to see them making progress with their mobility skills, their communication and speech skills, and being able to perform some functional things that they might not have been able to do in the past. We're just beginning our journey with Kids on the Go, but I have big dreams for this program. We're starting out small, and right now we have limited days that we're providing these services, but in the future I would love to include a greater age range of children in our programs and different types of programming. Maybe reaching out to different sports-specific programs like basketball, bike riding, swimming, different social skill groups for kids, hiking groups, sailing groups, and things that are really specific to our Northern Michigan community here that children can take part in and work together as a team. Well, we're very excited for any support from our local community, and we're thrilled to already have received a lot of generous support from different businesses and individuals in our community that have embraced our program. And we're excited for others to help join us and help build this amazing opportunity for children and families and help these kids achieve their goals and continue to make progress with their physical skills. Kids on the Go has a website, and that's www.kidsonthegocamptc.com, and all camp information and donations can be made through our website. Our camp registration opens January of each year online, and you can simply go to our website and log in there to register, or feel free to email myself or one of the other therapists if you have any specific questions about our programming. As a small and new nonprofit, we were able to pivot and move our services to an online platform where we were able to provide fun and safe therapy to a group of local children. And it also gave our therapists the tools to be able to work together and plan programming that we'll be able to build off of in future years.
This was good news. You know, the COVID cases were down. We saw the vaccine rollout. It started off a little bit slow. I know it's starting to speed up now. So this was good news. The middle of March, that, you know, the cases were down. We were feeling good. Things were starting to open up. Of recent, now all of a sudden we're seeing an uptick in cases. So this is a concern. It's almost becoming a battle between, can we get the vaccine rollout out fast enough to get enough people vaccinated versus how many people are getting affected. So we'll continue to watch, see where that goes. U.S. restaurant, occupancy has been slowly on the rise since the pandemic. Not quite back to pre-pandemic levels, but certainly on the rise. People are going out to eat. Traveler throughput, same thing. It's slowly starting to come back. We're not where we were at pre-pandemic, but good sign that we're getting there. That people are starting to travel again. This is something I haven't shown for quite some time. This used to be called the Bank of America Merrill Lynch Sell Side Indicator. Now they just call it the Bank of America Sell Side Indicator. Basically, this has been incredibly accurate at predicting what the market's going to do over the next year. By how? By determining how extremely bullish or bearish that, Wall Street tends to be. When Wall Street has been extremely bullish, usually that next year the market did just the opposite, and vice versa when they've been extremely bearish. Now that red line you can see in the chart is the sell side indicator. They're saying that's when you sell. If you look back at the last couple recessions we had in 2000 through 2002 and 2008, when this crossed that red line, indeed, the market did have a sell-off, and right now it's just getting ready to hit that red line. So what's it signaling or getting ready to signal? A sell. I just want to bring this up because this is the 4 stages of what they call a bubble. You got that stealth phase where smart money's kind of buying in. Nobody can really see what they're doing, but they're starting to buy into the market. Then it gets into this awareness phase. People are starting to recognize that things are are going good. So you got institutionals now kind of buying in, and then you get the public. They start to become aware. They get caught up in the enthusiasm. They're buying into stocks, and so you get this euphoria stage where they're just kind of drawing up, and it's where it gets into delusion, where you're getting pretty close to that bubble bursting. I don't know where we're at right now. It sure feels like from past times that we might be in that enthusiastic phase, and I can tell that by the number of equity inflows, which I'll show you here in a second. But what we want to be careful about is when we get into this kind of a phase, it's not bad. There's probably a lot of fundamentals right now that say we should be in the market. Things are coming back. We've got recovery. But let's be careful to understand that sometimes these bubbles can burst, and so we might want to run with the herd, but let's be careful we don't want to go off the cliff with the herd, right? And so we want to continually be looking at those fundamentals, making sure that we're not following it off the cliff if this is a bubble that's going to burst. Again, if you look at those indicators of fundamentals I was showing, as long as the earnings come along and we don't get any big surprises, this recovery is probably a little sustainable, probably has a little more room to go. But again, want to be very careful about following these fundamentals because we don't want to be the people that are going to watch the bubble burst and then our account values go significantly down, right? And again, here's this chart just showing the equity inflows. It's historically at all-time highs right now, right? People are feeling very enthusiastic about the market and they're buying in. Let's just make sure that they're not too enthusiastic, right? All right, folks, I hope you found this valuable. Certainly, if you have any questions about any of this, you give us advisors a call. We'd be glad to answer it. Thank you.